What's going on? Welcome everybody back to the channel. This video we're going to be looking at the macro economic environment that we're currently in. This isn't a technical analysis video, but if you are looking at that, you go ahead and click the link in the top right corner in order to watch the video I had posted next, which is the technical analysis of the past week, recap, and what to expect this following week. All right, so let's go ahead and go run through this shit. Federal Reserve, Bernard said that it's hard to see a pause in September, basically, that the Fed feels like it's their responsibility to lower inflation. Obviously, that is their responsibility, but they feel like they need to continue to keep pushing. And right now, the data they're looking at is basically supporting the idea that they should continue their interest rates the way they've been doing it. Some reasons why they might go back on that statement, or she might go back on that statement, is CPI data that's going to be released on Friday. So basically, the Fed is trying to bring down inflation. If the CPI data is supporting or even beating their expectations of what the plans that they had, the roadmap, then it's possible that they could slow down in September and just evaluate, how things have been going so far. This could work both ways. But if you do want a visual for this, you could look at the St. Louis Fed on their website. They do have an interesting graphs about a whole bunch of different shit. But basically, you can see how inflation has been peaking out already in March. If I fucking click it, there you go. 8.55 was the inflation year over year, and we had 8.22 in April. So hopefully in this release we'll be able to get in the high sevens. Doesn't sound very good. It isn't, but it's the steps that we need to take in order to get where we need to be at, which is around 2.5. Recession concerns from Elon Musk and Jamie Dimon. So Elon Musk, obviously the CEO of Tesla, owner Jamie Dimon of JP Morgan. Two major players have negative outlook for what's going to come. Not only that, Snapchat. I mean, even in the earnings call in Amazon, also looked at Apple and Microsoft. Like, they all have negative outlook. These major players, the major components of the S&P 500, as well as the QQQ, have major bad outlook for what to come in the future. So economically, they're expecting their earnings to go down, which kind of leads me to one of the topics that I also wanted to talk about, which, if I could find it in these damn tabs, I have too many tabs open. Where is it at? There you go. The earnings, basically the PE ratio for the S&P 500. There's been times whenever we had negative earnings, which is not really good. Right now we have slowing of growth. We're not necessarily at this state at the moment yet. But if we do get this negative earnings reports consistently missing, underperforming, and having negative growth, this is what leads to recessionary periods. There could be just slowdowns, such as the 2011 financial crisis or the repo in 2015. I think it was 15. It might have been 18. But anyways, if we get stuff like that, then we could avoid a recession, which would be great. But if a recession does come, always have that money on hand in order to buy the dip, because that's what's going to make you rich in the long term. I forgot how that the saying goes, but it's like bull markets make you money, bear markets make you rich. So this is an upcoming phase in where we could possibly use this type of environment for our personal gain, which sounds bad, but fuck it. Another factor to look at is the XLP versus XLY. So these are individual sectors of the S&P 500. XLP is consumer staples, so your Walmarts, your Targets, stuff like that. And XLY is more of your Amazons, more of wants that people spend their money on. So whenever this is going into a peak, that's whenever things are getting pretty bad, as well as the COVID crash. I mean, even the housing crash, as well as the dot-com bubble. Obviously you can see consumer staples are doing way better than consumer discretionary. Sorry, I had to remember the name. Currently having a cool off period, partially because of Target and Walmart's bad earnings reports, as well as Amazon's, which is a major component of XLY, has their stock split coming on Monday. Something also to look out for, because that could definitely perpetuate us for us. But again, I'm going to talk about that in a video later on when it comes to technical analysis. But those are the things just to consider. Something else is the U.S. Treasury Bonds, the 10-year yield, as well as the 2-year yield. We're taking a little break for like the past 3 weeks up until this past week that we had. We currently have a breakout to the upside. Will we continue to rise? Will we continue to fall? Who knows? But these go up in times of uncertainty. So that's something to keep in mind as well. And if you want to look more into that, there's other factors that play into it. But you can look that up in Investopedia or any other website that you trust your information on. Something else to keep in mind is the Consumer Confidence Index. Basically, people with the money they make it today, are they confident in their spending habits? Yes or no, basically. There's other questions that factor into this. Again, you can look into it if you want to. But basically, we're reaching levels that were seen in the housing crash, seen in the European financial crisis, even worse than COVID lockdowns, and we're continuing to head down. Where will we go next? Who knows? But their people's spending habits haven't necessarily changed yet. Their sentiment has changed because of these high inflation rates and stuff like that. But their their spending habits and their way they move their money hasn't necessarily changed yet. Personal savings rate is one of them. Something to look at. Basically, this is another thing. The St. Louis Fed provides a whole bunch of different information. Once again, you can go to the website. Great graphs, man. But anyways, this gives you a visual of people's saving habits. Usually in times of recession or even bad times, you people see people's savings rate go up as they're fearful of what can happen in the future, as seen in COVID, majorly in COVID. And recently we've been declining, and we're continuing to decline, meaning that people are not saving as much. They're using their disposable income for goods and other things that they want to be able to buy. Something that could possibly work against this, that's playing behind the scenes. I don't know necessarily how this is calculated, but if you think about it, if inflation's rising, so people's mortgages are, if they're renting, mortgages, if they got something new, bills, stuff that their needs go up in price, such as food, because of inflation, they're going to have less disposable income. If they have less disposable income, then they have spending habits that they like to do. And since their whole, I guess you say, disposable income is shrinking, but their habits of spending is staying the same, basically the gap in how much they can save is going down and down. It's not necessarily that they're spending more money because they want to. It's more spending more money because they basically have to. If that makes sense. I don't know. Maybe I'm not making sense. But anyway, another thing to look at is the PMI. PMI peaked out in mid 2021. Sustainably been in decline. It's another indicator basically showing us that we've already peaked out in our business cycle. Another thing, and these are a list of things that could possibly negate basically what the Fed, not necessarily negate, to agree with what Bernard said. Basically, I'm not getting to that yet. Sorry, excuse me. One thing I wanted to look at was the whole housing situation. So everybody knows interest rates on 30-year mortgages have been going up, highest we've seen since before 2011. Excuse me, I cannot talk at the moment. I had troubles in previous videos as well. Sorry, but interest rates 5.55. We're also looking at the cost of lumber, which is falling pretty rapidly ever since they started raising interest rates, which was in March, almost reaching pre-COVID highs. Well, not highs, but the level it was at pre-COVID. We're falling pretty close to that at the moment. And not only that, but we also could see that construction jobs in the unemployment data that came out, we saw an increase in construction worker jobs, when last month we didn't see that much growth or decline at all. So this is good to see. And the reason why it's good to see is that there's tons of homes that were under construction but aren't finished. There's been a lack of labor supply in the construction markets. I mean, you could go through this. This is data provided by who is it provided by? It's a government, obviously, because you can see it's .gov. But I forgot what bureau is the one who provides this information. But if you go through this report, basically you see the different numbers and statistics you can see of different cases. So for example, authorized units but not started. A major problem that we've had recently is things under construction has been rapidly increasing. Again, staying up there and how high they are. But units completed is going down. We're struggling with the supply of labor in order to fulfill these houses and to fulfill these permits and the permissions that have been given to people. So with the increase of jobs, a raise in interest rates, and what's called, what else was I looking at? Sorry. I was looking at different shit in here, and I just confused myself. Basically, and the drop of lumber supply, like it's basically going to bring home prices down. Less people are going to be wanting to spend their money because, one, a lot of people already have mortgages locked in, and they don't want to re-sign because they're going to have a lot higher interest rate that they did get whenever they were during COVID. So from a consumer's perspective, it's their effect that they've been having has been felt in the markets. But the question is that a lot of people have mortgages locked in at lower rates. So if their debt is fixed, no matter what the Fed does, there's that debt's still going to stay the same. So that's something to keep in mind, as well as corporate debt as well. I don't know where that stands, or I don't even know how to check that, but that's something else to keep in mind. Another thing to look at is just basically the amount of jobs that we've had increasing. I think it was a 3-month moving average for this data. It was like over 500,000 for 2021. And recently, it's been 450,000, I believe. And recently, this past month, we had 390,000 jobs created in the month of May. So that's pretty substantial. These are things that can negate basically them pausing in September. So strong job growth. We have a strong labor market. Retail sales have they have fallen as well, but retail jobs have fallen as well. But we're seeing a shift in spending habits going from products to services. So that's something to keep in mind because leisure and hospitality had a major increase for the month of May. So that's showing that people are spending less money at retail and more in services. Another thing to keep in mind is the quit rate. If people are worried about their economic situation, they're not going to quit their jobs. But we're pretty damn high up there. We're at 2.9% a quit rate. So again, you don't want to put yourself in a bad economic situation if you feel money's tight. But a lot of people are quitting still, usually to move to other separate jobs so that way they can get paid more. Another thing to keep in mind is the EU is providing their sixth round of Russia sanctions, which is good in combating Russia, but it's going to hurt the consumer majorly because oil is already going up. The thing is, though, is that how high can we go? There's some analysts that believe that we could hit five easy in the month of June, as well as $6 by late summer, and that's the U.S. average. That's not even like on the low end of the spectrum, so that's pretty crazy. And if I'm not mistaken, it's not all EU members. It's a majority of them. The smaller ones that rely too heavily on Russia's oil, they're not going to force them to participate in the sanctions just because their economy would collapse without Russia. So that's something to keep in mind as well. But since then, we've seen a breakout in crude oil futures, U.S. crude oil futures, and now it's a matter of testing new all-time highs. Basically, it's pretty scary because this shit's happening, and a lot of people I won't say aren't aware of it because they see it and they feel it at the pump, but it takes a while for crude oil futures to go get priced into the actual market. So we could see even higher gas prices from here. And those are reasons why the Fed would want to continue raising interest rates because they basically have to calm inflation. And energy as well as food is major components of the CPI data. And the thing is that a lot of it, even food, like the transportation of food and the transportation of goods, is dominated by oil. So it's really scary to think about it because that means our CPI might not peak out might not have peaked out in March. Those are things to keep in mind. The whole macro picture of the environment. I believe we're going to continue to tighten this cycle. It's not an expansion cycle. However, how far do we go? Have we hit the bottom yet? Who knows? That's up to you to interpret the data. Hopefully, this gives you a unique insight on how things have been going. And best of luck into trading, guys. Best of luck in your investments, and best of luck just regular financial decisions. It's tough, it's scary, but best of luck, guys.